Warren Buffett goes out in the public market and buys stock. He does not, because the top investors in the world were doing the exact opposite. Hey, what's up, everybody? Thank you for joining the Deal Room. I am super excited to jump in here for the first time. It means the world to me. Now, I'm really looking forward to getting to know each and every one of you and seeing where you guys are on your investor journey. You know, I'm going to keep things simple for today. I want you to grab a pen and jot this down, because you're going to hear me say it time and time again. The right private deals will not make you rich quickly. However, they will make you wealthy over the long term. Let me say that again. The right private deals will not make you rich quickly. However, they will make you wealthy over the long term. Now, that's not a tagline. That's something I hold to be true from my experience investing the last 25 years in both public and private markets. You see, when I started my career on Wall Street, it was all about short-term trading and liquidity. I thought I was doing everything right to build real wealth. However, I was shocked to learn I wasn't just wrong, I was absolutely wrong. Because the top investors in the world, when I started to study them, were doing the exact opposite. And these guys were making returns that were compounding. They were building true wealth. Take Warren Buffett. You know, America knows Warren Buffett to be the greatest investor and stock picker out there. However, where most people make a mistake and miss things is they think Warren Buffett goes out in the public market and buys stock. He does not. Now, he may be investing in public entities, but he's actually structuring it as a private deal. When Warren makes an investment into a company, he's negotiating preferred shares, guaranteed dividends, warrants, and board seats. You see, Warren, he didn't build Berkshire by trading. Warren built Berkshire by allocating capital and structuring deals that would pay him over the long term. Now, if we look at the largest private equity funds in the world, they actually go out and raise money from their investors. Their investors know that they're not going to see a return for at least 7 to 10 years. That's because private equity firms, they don't pander to Wall Street and try to beat the market quarter after quarter. They go in and they buy businesses. Their job is to go inside, streamline operations, increase cash flow, control the leverage, and exit when they feel is right. The same thing goes for VCs. Look, think about it like this. The first people that invested into Amazon and Google, their capital, it was locked up for years. There was no daily pricing. There was no liquidity. There was no quick exit. Their payoff came because the founders were able to build the business without dealing with constant market pressure. Now, here's the point. None of these investors were guessing. They were allocating capital with clear time horizons. Let's compare this to the public markets. I hate to be the bearer of bad news, but your returns in public markets are not driven by how good the company actually does. I cannot tell you how many times I've personally bought a stock. The company had earnings announcement. They blew away the estimates. The conference call went great. They're firing on all 4 cylinders, and the stock did nothing but decline over the next couple weeks, months, and years because something spooked investors. Your returns in the public market are driven by market mood, investor emotions, interest rates, and geopolitical risk. In the private markets, your returns are driven by cash flow, structure, and execution. Now, this is the part where most investors get it wrong. Most investors look to invest in the public markets to build long-term wealth, and they invest in the private markets and look at it as speculation. Institutional capital does the exact opposite. They look at the public markets for liquidity and the private markets for compounding gains over time. This is the exact reason why we see more and more companies not going public at all. And this is why venture capital and private equity firms are okay with longer lockup periods, because they know patience is not risk, but misallocation is. So my goal in the deal room is to not have you guys run out and start doing private deals, but more importantly, to understand how the top allocators in the world structure and allocate their capital. Some capital will stay liquid, some capital will be positioned for income, and some capital committed to opportunities and private deals that'll work out over time. When you understand that, private deals stop feeling risky and feel more intentional. One thing I can promise you guys is real wealth is rarely ever built quickly, but it is built deliberately. And that's the foundation I want to start with inside this group. Look, I'm going to start dropping more investor IQ posts to bring you guys up to speed. I'm going to put some polls out there because I really want to see where you guys are at your journey. And I want to curate the content to what's going to help you moving forward. And now, if you're in this group because you're looking to raise money for a deal, remember, every deal has to come through us and be vetted first. So if you have a deal, feel free, shoot me a DM, and me and my team will get back to you. I'll catch you guys later.